Hi, value investors. I want to talk about Warren Buffett and quality investing. And Charlie Munger is often accredited by Warren himself as being instrumental in moving Warren away from investing in cigar butts and net nets towards quality stocks. Now, this is mostly true, but is not 100% true. The best example that I could find was in Warren's partnership in 1965 when Buffett invests in Walt Disney. So obviously Walt Disney even then was no way near a cigar butt. So although the story is that Warren chose to go from investing in cigar butts to quality stocks after meeting Charlie, I believe the actual story is that Warren, although he doesn't really talk about this that much, but Warren was solely focused on buying the maximum discount from value. So at that time, in 1960s, the best discrepancy that you could find in value was buying these kind of nets, these like businesses that nobody wanted to buy below working capitals. Just a reminder, a net is when you buy a stock for less than the current assets minus all its liabilities. So probably do a video on that later on. But basically, um, what the cigar bust that Warren was doing just had such a large margin of safety. And it's not that he later on was not interested in them, it's just that he had too much capital and he much preferred to leave a legacy. Because by the age of about, I think, I could be wrong on this, but I think by the age of 30, he'd already hit a million. And the $1 million, approximately 1960 something, was worth a lot of money back then. Um, and it's still worth a lot of money now, but it was worth a lot of money back then. So by the age of 1965, he's more interested at that point in really leaving a legacy. And that's why he kind of starts being a closed down his partnership. It's not that he really thought that stocks were super overvalued and they'll never return to anything higher than that. Because if you remember the story, Ben Graham actually told him when Warren was working for the partnership of Graham's partnership. Graham said, "Oh, don't invest your $100 in the stock market now because the stock market has never crossed this point." I don't remember when it was. I don't remember the date. You could look it up on the Lawrence biography, but it was approximately at some point 1950 or something like that. So it's not that Warren thought at 1969 that the stock market would never cross higher than that. It's just that Warren is not so aggressive in terms of trying to outperform so much. He is aggressive, and as you can see from 1969 to 2020, he does still do through Berkshire Hathaway, still does 20% a year, but 20% compounded is not as much as 30% compounded. And unless you these numbers are huge differences. To compound at 30% is astronomical versus compounding at 20%. 20% is okay, but it's nothing in comparison to 30%. So long story short is that although that Charlie gets gets the story. Sorry, I had to catch my thoughts. So although Charlie gets accredited, the Warren Buffett is actually responsible for himself recognizing that franchises and monopolies make for much better investments than net nets. Thank you for watching and subscribe.